Good afternoon and welcome back. So we're hoping the next panel session is going to be as entertaining and engaging and challenging as our previous equities market structure panel. Just so that you're aware, we've got 968 individuals have been registered and are watching this. So it's clearly we are discussing the most important topics of the day. And with that, I would now like to hand across to my colleague, Matt Coop. He will be discussing factors causing fragmentation in fixed income markets. Matt, over to you.
Thanks, Rebecca. So, there's a lot going on in fixed income markets, and I think we had a really entertaining panel in equities covering some really key topics and looking at things that we need to work on, what we need to deliver, and also to cover work that we've already done. And there's been a lot of work done in the industry around fixed income. So for this panel, what are we looking to cover? We're looking to cover fixed income markets. They're still traditional. Do they just still purely evolve around the provision of risk? We've seen a huge amount of automation. What is happening with this? And also, we've had a huge amount of regulatory change. Is this stifling innovation? Is this holding us back? Could we do more? So what we want to do is go through where we are now, where do we want to be, and what goal do we want to achieve? So to do this, I've got a great lineup of panelists who I know for a fact are never afraid to give their opinion, make their opinions known and to make it clear. So for the panelists, I have Mr. David Bullen from EMEA, which is a trade association which represents fixed income venues. We have Louise Drummond from Aberdeen Standard, who's Global Head of Trading. We have David Kamara from Goldman Sachs, who's Director in the market structure. We have Andy Falco, who is Head of Fixed Income Trading at Fidelity. And we have Raj Padamandi from Market Access. And to round it off, we have Frank Chatillon, who is the founding partner of Greenwich Dealing. Right, so we've got a number of Slido questions. And I think this is critical in terms of trying to move this forward. We've got some questions which are live. So please log into Slido. Please make your views heard. And we have one live already at the moment, which is, what do you think the primary focus of policy for regulators in fixed income should be? So that's live. Please come in and feed that into that. But just to start off with, what I'd probably like to do is, David and David, I know that we talk a lot about regulation. I was wondering, could you maybe give us a bit of a summary of what's going on and where the key areas should we be looking at this?
Yeah, sure. So we have a packed agenda in front of us, I think, in the summer and in the fall. First of all, I dread to say this, but MiFID 3 or MiFID 2.1 may be coming. And we will have a lot of consultation on this, both from the UK and EU. And I think it will basically focus on two topics. One is transparency, and the other one is market structure. And then we have CSDR coming next year, the Settlements Directive, which will imply mandatory buy-ins for cash, bonds, and equities. That's in Europe. Obviously, in the US, there's SEC coming up with rules as well, which is part of the Dodd-Frank package. And there's a refurbishment of some of the CFTC rules coming as well. And in Asia, there's a lot of activity around derivatives. So, I mean, as you can see, it's a full pack. Now, the thing that is starting to worry us more is not the fact that the list of regulations is long, and we already know that, and other panels have touched on it, is the fact that there's a lot of bifurcation and divergence coming from these regulations, mostly between the UK and Europe. And that is becoming a topic in its own, both for things like DTO, derivative trading obligation, or clearing itself. So the fact that the two regimes are likely to diverge in the next years is worrying and needs to be tackled as a single element. David, maybe you want to add.
Okay, absolutely. Yeah, David, that sets the scene very nicely. I'm going to focus just on the UK and on Europe. I guess, I think David said it. It's the MiFIR reform. But remember, it's the UK and the EU versions of that, and the UK hasn't really got out of the blocks yet in terms of giving us a feel of what they're going to change and what they're going to look at. For us, just to unbundle MiFIR reform, it's perimeter issues, it's the consolidated tape, of which there was a dedicated panel on, and certainly we heard about that much more today. There's also things like market making arrangements, clashes between DMO obligations and MiFID itself. central bank exemptions. There are bits and pieces there that are very relevant. The first two, most importantly, the perimeter issues, the consolidated tape. Everything else is relatively minor and relatively fixable. And then CSDR, the February 22 date. And if you weren't able to catch it, I moderated a panel on that this morning, which was very insightful. Main takeaway, if you missed it, was that 3/4 of the audience expected the material changes to the settlement discipline regime would be implemented. But I think we were left with the conclusion that was very optimistic, and there was no evidence to justify that optimism. And with only 9 months left to do, 8 months left to do 9 months of work, apparently that is a challenge for the industry. But last comment on regulation is I'm hoping, as an old practitioner, for those who know me, that regulation will play less of a feature in the next few years than it has in the past, and good old-fashioned innovation will come back to the fore. Matt, back to you.
Thanks, David, and thanks, David. I think that's really useful. Let's just see if we can bring up the results of that poll. It's quite nice. I can see them on the iPad. What we've clearly got here is an outcome where basically improving transparency, a dead heat, and also delivery of consolidated tape for bonds. So I think that brings us quite back nicely into the next question. It's worked out this way, is that there's obviously a lot of global transparency reviews going on. There's going to be a review when we're looking at US Treasuries as well. And let's start with the buy side, because this is critical. The representation of the end investor, the bond market is mostly a wholesale market. So Louise, what do you want to see around transparency? It's obviously been a topic of much discussion.
So I think I sound a bit like a broken record. I think it's the same old, same old. We really want to see good quality, clean data, that we can use. And again, I think very much looking at what the US does with Trace. I'm not quite sure why people haven't tried to adopt that. And then again, looking at delays, and one size doesn't fit all. And I think that's the issue we have as well. Different asset managers manage different types of assets. And from my perspective, we're probably large, in most markets. So where I'd want to see more transparency, obviously, is in the credit markets and the MD markets. But I also want to be able to see a delay, in those prices, whether we're working a large order or whether it's market sensitive. We want to do the right thing, for our clients.
And Andy, I know you've done quite a lot of thinking around this, and when you're looking at the UK versus the EU market, what are your thoughts? What do you want to achieve from transparency, and do you have any concerns?
Yeah, so to Lou's point around obviously sort of Trace versus the UK versus the EU, what we're looking for is something that's slightly more standardised across the markets. When we look at Trace and obviously the reviews that have been done there, obviously sort of there are areas that could be improved within their own framework, and we should be looking to learn the lessons of MiFID II around the transparency that obviously we've seen come through, and look to apply a slightly different framework. A Trace-like framework would be where we would like to see obviously the market in the EU and the UK end up. Thanks a lot.
David, I've lost track of the number of hours that we've been talking about transparency. David Kamara. From a sell side perspective, what's the balance here? Where do we want to be with transparency?
Yeah. So the first thing I'd say is I think the main culprit of all these conversations and why we're having this and why we're all, I think, a bit frustrated with MiFID is the fact that, there's no common access, or there's no real source of global transparency as there is in Trace, right? There's not a single point where people can connect and see what's going on in the markets. And I think that's the main topic, and that's the topic that should be addressed first. So in other words, the CTP or the debate about the CTP. We think fixing the transparency rules at the same time may be a bit premature because there's still no evidence of whether the transparency is good or bad. No one is able to see it all aggregated. That's our main point. If we wanted to adventure in changing the thresholds and the parameters before we actually see them happening, which I think is our view, we would be in favor of some level of simplification. But obviously, we have to be careful with been acknowledging that like liquidity in these markets is mostly still provided by balance sheet, which means that we have to be careful about which trades we disseminate and when. So potentially a level of transparency that is slightly simpler with an LIS or an equivalent to LIS that works, and with a certain deferral for above LIS trades could work. But again, I don't think we're smarter than 5 years ago when MiFID II was put together, right? And there was a lot of thought and number crunching to do MiFID II transparency. And I don't think it's wrong. What I think is not ideal is that the data is not accessible. So that's our view.
Thanks, David. And then coming across to Raj, I mean, as a market operator and as someone who provides a number of data products, what's your view around transparency? Is it everything should be printed, or how are you approaching this?
Well, hi Matthew. Thanks for having me. I mean, ultimately, my view is that we want to see transparency without being necessarily prescriptive about the mechanism for getting there. So there are a couple of beliefs that I would have. The first is that we should try and ensure certainty of execution in all market environments and not just volatile ones. And the second is, I think all of us on this panel would say that we're stewards of responsible fixed income markets. I have a belief that the transparency will probably end up driving a better outcome for the customer. But I think David's point was very well made. Actually, we need to find a balance between protecting investors against information asymmetries while also making sure that liquidity providers aren't disincentivized to take risk. And I don't particularly have a prescriptive view on how we reach that point. But ultimately, I think transparency is a desirable objective with the interests of the end investor in mind.
Thanks a lot. I think that's a view that seems to be coming through. And so then the next step, Frank, from your perspective in terms of an agency model, do you think the delivery of more effective transparency, the delivery of a consolidated tape, is this going to change the world of execution for fixed income for you?
I think I'd say by all of us, I mean, around the table, I mean, transparency is linked with liquidity and data access. So we were referring in Europe with a consolidated tape. And it's been 5 years or 6 or 7 years that we were, waiting for a good solution for consolidated tape, which is until today not so efficient. Platforms such as market access or Liquidnet offer liquidity access to liquidity providers, so we can open one counterparty or two counterparty or three counterparty, but also offer access to what we call open trading or multilateral solution, which is kind of agency model. So we've seen since few years many broker dealers offering OTF solution agency model in fixed income. Nevertheless, we know that the primary market is still in the hand of the bank, and if we want to access the primary market, we need to maintain a relationship with the bank. So and not agent, unfortunately. So the solution moving to more agency, accessing more liquidity is nice, but I mean we need to also review the access of primary. All the provider, all the buy side are not treated in the same way. I mean, small asset manager only have access to potentially ETF or agent broker because they're not allowed to open big banks' names. So access this big liquidity, especially in credit and high yield. So there's really no level playing field in the fixed income market. And but agency try to find their place in their this new landscape.
Thank you. And Mr. Bullen, we've had a MiFID around for a few years now. I think a lot of us on this panel have been talking about transparency and fixed income transparency for longer than MiFID's been involved, and I know I've been boring Andy and Louise about it for way too long. Why haven't we hit our objective? I know you represent the trading venues, but there's a large majority of data from the trading venues. There's also the APAs as well. Why hasn't it naturally evolved? Or is there something else that we need to fix and to work on in the industry to try and hit this objective, which everyone seems to think we could get to?
Okay, Matt. Yeah, very good question. I mean, I think we said it, but what is good transparency to someone is not necessarily the same definition to others. So that's problem number one. But we'll get past that. We all know transparency. Too much transparency can hurt certain players in the market. And I'm going to coin the expression. Getting that balance right, which we were talking about, is an art and a science. It's both. It's very, very difficult to get that balance correct, but that works on. I would contend that transparency has improved since MiFID, but MiFID 2 isn't finished yet. I mean, we've got to bear in mind there are still stages to go through. There are ratchets, so we used to call it ratcheting up of the regime, which still haven't happened yet. And also, as we all know, there are going to be some tweaks and reforms to MiFID coming up. So let's not judge the book when we haven't actually finished reading it. It's still work in progress. I would pick out on something that Tilman Luder said at this conference earlier today, that the consolidated tape required some changes to existing legislation in order for a successful tape to emerge, and that will be a big benefit. And also, I'm old enough, and I've talked to people who are old enough who were involved in the introduction of Trace many, many years ago, and they tell me it took a long time. So I know it's not great to say be patient, but I think it's improving, and I think it will improve further.
So, sorry, Matt, just a point on that, if that's okay.
Yeah, go for
it. I mean, as it relates to Trace, I absolutely agree, David. But what we have at the moment is we're in a halfway sort of state. What we're looking for is Goldilocks, and we can't find that particular basically individual so far. A simplified version of Trace with a more narrowly defined set of instruments would improve the transparency picture very, very quickly. And I think as well, going back to MiFID 2, if you ask the people on this call in and around obviously sort of IBEA and COFIA, were they the right frameworks to help transparency? It will be interesting to see what the audience think on that.
I think that's a really good one. And just to go back to David's point, I think for Trace, I think we've been 15 years in terms of trying to get this working. And that shows the amount of time in MiFID for 2017. So I think that's a very valid point, David. David Kamara, I think is an interesting point. And I'm basically throwing the script out the window here because I think, we're moving along. David raised a very valid point in terms of the ratcheting up. And then Andy raised the point in terms of IBEA and COFIA and in terms of the approaches of how we look at transparency. As you know, I always use the phrase MiFID was the biggest transparency regime ever in existence globally to come in one go. But what are the challenges that are coming on from that side of things? Because I know you and I, we bore each other hours every day in terms of trying to talk about it, but maybe you could do a quick review there.
Oh my God, so many questions in the same question, Matt. That's a good present. So yeah, I mean, the thing is, between IBEA and COFIA, I think part of the culprit of all the complexity around that was probably the pre-trade transparency. I don't know if others would agree with this, but I think pre-trade transparency on SI in fixed income scared the market so badly that when pre-trade transparency, it's still implemented, but when it was, I think it was the main problem that people faced. And because of pre-trade transparency, there was a lot of reluctancy to go on with a simple regime because people wanted it to apply very granularly at an IBEA level, just in case we were exposed on pre-trade to larger trades. And I think as time has passed and pre-trade transparency is there, but it's really not being used that much, I think the market is more probably in line with what Andy was saying of simplifying the whole regime. And I'm not sure if either going to a full COFIA approach or class by class, so that similar to the US, we have high yield and investment grade or something similar, but definitely probably trying to simplify the scope and create a smaller universe that is subject to more immediate transparency and a larger universe that's subject to longer transparency. I think that's more or less the root out of the problem you're posing, Matt, which has like many legs. But yeah, I think pre-trade transparency is the main problem that caused the industry to go so complex. If we were to agree that pre-trade transparency in fixed income is not really being utilized, and by pre-trade transparency, I mean imposed pre-trade transparency by regulators, not the full array of pre-trade transparency that's currently available in the market, which I think is positive. I think the pre-trade transparency imposed by regulators is the bit that needs to go away. And in that case, I think people will be more ready to have a simpler approach to post-trade. But I'm happy to debate on that as well.
I think we need to move on because there's a lot of content we've got here, but I completely agree. And it's not a simple thing because when you bucket millions of instruments together, and they all have different attributes and different changes. How do you get the right balance here? But the next thing is we're going back to the title here and looking at the fragmentation. But I've put the Slido question live around about what the operation of a bond consolidated tape and would it improve liquidity? And it would be great to see what people think around that. But whilst people are looking at that one, let's go back. Let's look at the title of this subject. The title's not just transparency. We've got a number of rabbit holes that we need to run down here, and that's fragmentation of liquidity. And I suppose the question I'd ask is, how do we define fragmentation in fixed income? We are not an equities market. The majority of liquidity is not executed on an order book. There is primarily an RFQ model that engages, but there are other models evolving. Are we seeing fragmentation, and where does this need to go to? So, Louise, if I could turn to you first.
Yes, I suppose I wanted to bring something else to it because, fragmentation, we're just talking about, from the liquidity and the pricing perspective. But we are getting more fragmentations brought to the market by the factors. So, we've got the political and regulatory impact that's brought some fragmentation, which does affect liquidity. So that's from the 3 trading venues we now have for derivatives. Again, we've got some European regional banks that can't quote on platforms. And as has been mentioned earlier, CSDR coming in, next year will bring potential fragmentation with liquidity, again, on how people trade, where they trade, and will people be making prices. But if we're looking at the pricing element, again, there's so many sub-asset classes in fixed income. So, we have different levels of liquidity there and different pricing. So if we're looking at the EMD markets and the credit markets, then there are different venues to price. But again, I think the platforms have been extremely useful and listened to our needs, over the years. And we're getting more and more solutions in place to access that liquidity. So, again, the dark pools, all-to-all alerts to bonds, that we're interested in, and also, the ability to be a price maker rather than a taker.
So it's the evolution of different protocols which are coming through. Just wanted to quickly close off on the question I left around the consolidated tape. 78% of respondents said that actually a consolidated tape would help liquidity, just for the record in terms of what was going through. Going on from that, Andy, do you agree with Louise? Are you seeing a real change in terms of the methodology of how you're executing today, or is this a future state that we're looking towards?
So I think it broadly sort of looks towards the future. As you sort of look at the different trading venues, over time, it's going to become clearer to market participants as to what the cost of the trade actually is. And I suppose in many ways, obviously, sort of we look towards the venues to basically sort of be slightly more transparent in regards to the total cost or consideration of a transaction that is being pushed through the likes of MTFs. To Lou's point, in and around venue choice, venue selection, that will then come into obviously sort of your execution policy around why you use one venue, which may be more expensive versus another, with a better outcome, obviously sort of for the end investor. But obviously sort of competition is obviously sort of what is needed. We sort of obviously are very keen to see more of that. When you think around fragmentation, though, the problem I think that Lou sort of alludes to around political sort of change over the last couple of years between the EU and the UK are obviously sort of creating different networks, different basic sort of areas to access liquidity. And I think that will become more problematic over time. The other question would be for a buy side, basically sort of head or organization as a whole, is with all of this fragmentation coming through, where and how do you basically collect the data? How do you start to think around obviously your own data strategy? And in and around obviously the EMS conundrum, which has obviously sort of been relevant within fixed income over the last few years, which all of these things cost. So fragmentation could basically sort of be to the disadvantage of smaller asset managers and to the somewhat advantage to the larger houses.
Thanks, Andy. And while I've launched the next Slido question, it's great having the control and power from the iPad, which is actually in terms of, are people seeing fragmentation or increased fragmentation since MiFID went live? David Kamara, I mean, Andy talked about the cost of execution, the execution in trading venues and what's happening. What are you seeing in terms of the approach and how execution's evolving across the different trading venues and the protocols made available?
I mean, we first of all, we think competition is key for innovation, right? So we're in favor of every trading and all trading venues having different offerings and their cost models, which are, by the way, published in the rate cards, right? So we do think that each trading venue offers sometimes different protocols, different flavors, different levels of integration that sometimes justify the difference in cost. So we do think that fragmentation, actually the fragmentation that both Andy and Luis were touching on, which is more related to different markets, different regulators, political storms, is much more worrisome for the market. That fragmentation coming from innovation, right, which is actually probably positive. We do think that the current political storm between the UK and Europe is problematic, and I call it storm. I mean, it's probably overstating. It's not a storm. It's the direction of travel after Brexit. But we're extremely worried with DTO lack of equivalence, and especially with the clearing potential lack of equivalence of clearing, which, as I said before, will put us in a cliff edge scenario at the end of mid 2022. And I think that kind of fragmentation is what worries our side more.
Thanks, David. And Raj, from your perspective as a venue, there's been transparency around pricing or how things are evolving. What's your views in terms of how that's evolving and the competition you're seeing on the street?
Well, I mean, we welcome the competition. I mean, I think I'd echo David's words. I think that's the second time I've said that today, so I'm agreeing with David a lot. But ultimately, I think competition drives better outcome for the customer and ultimately drives a more efficient market structure. I think it's really important actually that innovation doesn't happen in a silo. Certainly at Market Access, one of the things we try to do is innovate in close collaboration with our clients. And obviously everything we're trying to do in terms of innovation is predicated upon anticipating our clients' needs. So in that way, we hope to make the market structure more efficient. And if others are doing that as well, then it's something that we welcome because it moves the market overall to a better place. And as I said at the beginning, all of us on this call, care deeply about the fixed income markets and the end investor. And the innovation will push us in that direction.
Cool, thanks a lot. And Frank, a couple of times in terms of looking at the difference of protocols, the evolution, there's more complexity there, more complexity of data, as Andy was saying, in terms of aggregating this. Are you seeing this in terms of from your clients? Are they having bigger challenges in terms of trying to aggregate this and pull this together, hence why they're sort of reaching out to yourself? Or how are you seeing this evolution?
First of all, I would like to say that electronic platforms are really boosting transparency, but it's still a long run to go before we can get it. I just want to compare equity market. When we, as buy side, when we trade equity, we have a connection. We have a connection between our OMS and one EMS in order to access all equity market. For fixed income, every time we want to connect ourselves with a different platform, we need to connect one by one each platform through an API with an OMS. So technically, in terms of technology, it's much more complex to operate and to have a, let's say, a good evolution in our connectivity with the market. So this is something that should evolve in the future. With regard of the access to data, it's still something difficult. I mean, as Louise was saying in the beginning, I mean, we still have issue with the quality of data. The data we can use in order to make a decision as a PM portfolio manager is something critical. So there is something to be done on consolidated tape for sure. And as Trace did, as we already said, since 15 years, but we need more data. We need more quality data in order to perform more investment decision and operate the execution.
Thanks. And so, David Bullen, we need more data. Is that true? I mean, surely, let's have that mandatory contribution. Let's create that consolidated tape. Is that going to solve all our problems? Is there anything else we need to be looking at?
Matt, thanks. Listen, I'll get to that question, more data in a second, but I just want to go back to your original question some minutes ago. Fragmentation. Let's just be clear. Fixed income is a very diverse asset class. And if you're coming to fixed income with some sort of equity lens, you will never achieve the less reduction in fragmentation than perhaps you want. Brexit has clearly led to more fragmentation. We have effectively two MiFID II regimes to work with. And do bear in mind, most trading venues have a global technology stack. In fact, I would say this is true for most people. We try and have one very good technology stack somewhere in the world, and you adapt it to regional manifestations if you can. So that is a real issue. But just on a positive note, I'd like to say the EDMA represents regulated markets and MTFs in the UK and Europe, and we have 7 member firms, and I'm not looking for any new ones. So there are already 7 major providers in that particular space, and I don't think that's overly fragmented or diverse. And I'm pleased to hear they're offering some competition around innovation, and Raj is on here, one of my members, speaking to that himself. So I don't think that is a particularly fragmented landscape. And also, I think that innovation somewhere is the opposite half of fragmentation. If innovation is to be doing what clients want it to do, then there will inherently be a level of fragmentation. On the data question, Matt, I don't think there's a need at the moment for more data. The data, there are different types of data. The data inside, for instance, regulated market and MTFs and produced by venues, because of the way trades are consummated on venue, is of extremely high quality. I don't, as you know, represent the APA community, and I can't really speak to data that's flowing in from APAs, but I can absolutely say that the quality of data in a regulated market and trading venue space is of extremely high quality because it's effectively printed on a trading venue.
Just one question around that when you're coming back to your point on the 7 venues. Surely the other part of this is what Frank mentioned, is that when we're looking at the fixed income market, the buy side is directly the member of the venue themselves. So that is a greater fragmentation, and also potentially the bilateral facilitation on the OTC trading or SI trading that might go through as well. So, yes, definitely we don't have the same structure in equities, and it operates in a different manner. But Louise, Andy, I mean, do you see a technological challenge at the moment in terms of accessing everything, or have we got what we want? Okay, either one of you jump.
I'm just thinking about it. Sorry. There's probably a long list of things that I want, but where am I going to get them? I don't know. I was thinking from a technical point of view. I mean, I'm just looking at workflows. I think a lot of us are all in the same boat. From an automation point of view, would like to be able to automate more of our flows, and I think that becomes challenging just the nature of the different sub-asset classes that we do, and also as well probably more around the packages of that, and being able to get something in place that could be able to automate some of the added credit and a hedge attached to it. There's probably other things, Andy. While I'm still thinking.
Yeah, no problem. I think. Hello.
Hello.
Okay. In relation to Lou's point, absolutely. So automation is obviously sort of an area that's going to continue to evolve. When we look at where we began 3 years ago within the rates market to where we sort of have visions of going to, a decision tree to assist the traders to look at sort of lower value orders to be basically sort of to receive the same level of care as they do today is the primary goal. So ensuring that the execution quality is equal to what you would get from a human being, basically sort of engaging with the trade is the outcome that we're looking for. I know that others within the industry are keen to sort of push the view that that should improve the execution outcome. If I was an investor, I'd be a little worried personally around obviously sort of that type of sort of statement. But for us, this is more around we have a process that works. We evaluate trades on a trade-by-trade process. We have an execution policy that obviously ensures the appropriate outcome for end investors. What can we do to kind of automate it? So that for us is something that we've built and continue to build in-house. As it comes to data, order management systems are obviously sort of key to the buy side, particularly in Europe. Pre-trade checks are obviously sort of a must definitely for Louise and myself, and obviously sort of, but at the same time, that makes consuming data within those sort of constructs a little harder. So being able to have point-to-point connectivity to be able to engage with venues seamlessly, to be able to bring the picture as to what you were looking at the time of trade, are areas that we are obviously looking to expand over the coming years. You know, when you think about a one trade versus the next, and when you're signing those trades off, when you've got different tests that are being met as part of your execution sort of analysis, we haven't, as a marketplace, got that sort of artistic picture that basically balances, to David's point, I think, around the quantitative and the qualitative aspect. Where were markets at the time of the transaction? When you're thinking about a particular bond, how do you prove out that that was the right outcome? So I think that there's much more to do over the coming years, and I think we're in a pretty exciting sort of venture right now. Again, when I look at sort of the world outside of fixed income and consider sort of DLT technology and what that could bring, could actually sort of deliver, I think we're at sort of quite an important inflection moment in 2021, where crypto type technology, let's leave the likes of whether there's any value there to one side. Let's focus on sort of DLT, where there actually is a use case within fixed income. That's only just beginning. Obviously, sort of you'll all have seen the announcement yesterday between where Goldman's and JP Morgan have said around their partnership as it relates to repo. EIB issued obviously their first note. Obviously, what was that, about a month ago, I think it was, and other corporates have done similar. And I think that's only just beginning. So I think the message really for the buy side as a whole is to not get left behind. Effectively, the market is moving, and technology is advancing faster than we may wish to kind of like. But you need to kind of be very focused on it.
Perfect intro into the next segment, Andy. Thank you so much for that. It was beautiful. So the next bit is technology and trading protocols and how this is evolving and how it's amending. So are we seeing technical innovation? And also, I think another sort of thorny topic that's being discussed is when we're looking at what is multilateral versus what is bilateral trading. Is it just a technical facilitation of a trade? Is RFQ1 multilateral? Is that venue? I know there's been a lot of conversations around that. David, do you maybe want to frame the discussion and the debate, and David Bullen, and move on from there?
Happy to in terms of the multilateral versus bilateral issue, absolutely. And I will take an attempt at arguing that RFQ to one is indeed multilateral. The reason for it is simply that a multilateral system is, if it allows you to launch an RFQ to many counterparties, but you choose to limit it to one, you may well have a very, very good reason for so doing. That is entirely, if you like, your choice. And having spoken to key authorities on this very point, ESMA for one, various European national competent authorities are very, very clear that facilitating interaction, irrespective of whether trades get done, is multilateral and needs the appropriate licenses. That is their clear definition. It was in their OTF consultation back in November, and we fully expect them to come out with something later in the year that clarifies that for the market. On that particular point, Matt, I hope that opens the bidding, if you like.
I mean, interesting. I mean, I suppose my first question then is: a dealer board multilateral? So therefore, we need to have dealer boards regulated as MTFs.
You should talk to. Go ahead. Yeah, sorry. Go ahead.
No, I was sorry, David. I'm interjecting maybe here, but I think we have a bit more of a balanced view, not as blunt as what you're suggesting, David Ballen. I mean, yes, there's been a lot of literature coming from ESMA and other regulators on multilateral versus bilateral, but I think the whole definition of MTF or OTF is much more complex than just the fact that it is multi or bilateral. There are some paragraphs in those consultations saying that, you know, it's the multilateral item that matters, but there are many other paragraphs talking about execution, talking about fees, talking about system and whether things are done through a system. So I mean, the interpretation of whether something needs to register as a venue or not should not only be taken on the multilateral versus bilateral aspect. We do think it is much more complex, although we do think there should be a line drawn and everything that acts like a venue, looks like a venue, and offers services like a venue should be regulated as a venue, just to be clear. But maybe our view is a bit more, I would say, mixed than David was putting there.
Louise, Andy, I mean, from your perspective, you know, venues provide a lot of processing for you in terms of certainty, rule books and everything like that, but obviously the bilateral relationships are still important. This argument's been trundling along now for a long time. What are your views from the buy side's point of view?
Well, if I was start, I mean, again, I think it goes back to, I think what Andy said before as well, is that, you know, every trade you're assessing for the best outcome and the best way of processing that trade as well. So it's on a trade by trade basis.
So, and if we go back to the point of David's perspective, is if you're able to process and access multiple people through this technology and RFQ1, then that needs to be regulated by a venue. Yeah. And is that a good outcome? Because I mean, there's going to be a lot of cost there, maybe.
Yeah. Matt, can I jump back in? Because I said I was opening the bidding. I hadn't quite.
I rushed in.
No, that's okay. I mean, just because what I laid out earlier was a theoretical point of view. So, I mean, to David Kamara's point, we're a lot more realistic in practice, and we are working with ESMA, if you like, and the authorities to make sure that they do understand the nuances. And at some level, we're coming up with simple suggestions like, if a trade is consummated on systems but it ends up being printed through a regulated market, MTF or OTF, then the preceding systems technology, are very likely not in need of licenses. Each case needs to be taken on its own merits. They were trying at some point to look for categorizations of companies. One of them I spoke to wanted to assess the entire fintech landscape and be familiar with all the companies operating in fintech in order to get to the bottom of this issue. And I thought that wasn't a useful use of their time as regulators. It's too big an exercise. So I would agree with David Kamara and others. It's a little bit more complicated and nuanced. We are hoping to work with the authorities to help them through that.
Definitely a complex debate, and I totally agree with you, sir. And potentially maybe there are other regulated platforms in terms of execution venues, maybe including SIs to that list as well. But that's like can of worms. Moving on, Frank, from your perspective, technical innovation, as you said, how are you seeing this evolving from how you're positioning things?
I think, as has been said, so there's we need to have the capacity to trade bilateral and also multilateral. We're referring to RFQ. I'm sorry. We don't trade every assets through RFQ. If you trade bonds rates RFQ, which is fine, but high yield, you make noise. So RFQ need to be used function of assets you trade. I would also think that in terms of technology evolution, we also need to connect the technology we use, an OMS and EMS, with the capacity to access and run, but also primary markets. So the day we will have the possibility to have all access and run from the provider, liquidity provider, and primary, combined with the capacity to trade multi or bilateral, would help a lot for facilitate the trading access to liquidity. So
I'm conscious of time, because I know I've got big red numbers being flashing up at me. We've missed one segment in terms of the real evolution that we're having here in terms of AI and machine learning and how fixed income is going through a revolution. So question to everyone, are we going through a revolution? Are we going through an evolution? Are we going to see a big change? And I will do it in order in terms of how I can see it from the Zoom screen to me. So for Mr. Bullen, what is your view?
I've been doing this for 30 years, Matt. It's evolution. It always has been. I'm old enough to remember the dot-com bubble in 2000. World Wide Web, internet. We no longer need banks. I was in a bank seat. It's never revolution in this world. It's always evolution, and I'm firmly in that camp. Unfortunately, a DLT will make a big difference to Mr. Falco's point, but it will be through evolution, not revolution.
David Kamara.
I mean, I think I've seen evolution in the last 10 years, but probably the curve is a bit steeper in the last couple. COVID and unfortunately, and other things I think have made these, I wouldn't dare saying revolution, but at least a fast evolution in the last few months, right? Both in terms of protocols, innovation, DLT, and many other things happening around. I wish regulators would be able to adapt to this and help us regulate in the right way for the market, which is a lot more pragmatic and a lot more based on data.
Raj.
Yeah, look, I think the speed has really picked up. The combination of the pandemic effect and what that's meant for price formation and the advances that we've seen in technology in the last couple of years. So cloud compute, AI rather, ML. I think all of those things are speeding the pace of change and innovation. So it feels like innovation is happening more quickly than it has done in the past. But I'd echo David's point. I mean, we're evolving. Perhaps it's just a slightly faster pace of evolution than we've seen in previous years.
Andy?
So I'll break with the consensus. I think we're at a very kind of key moment. To your point around obviously sort of I've raised around DLT. That's just the first of those sort of changes. The pandemic has got everyone more comfortable with obviously sort of the roles being performed in a non-office environment. I think that will accelerate. I think that there's a very high chance of greater sort of utilization of outsourced sort of trading and trading models. That coupled with the technology side as well, I think we're in a revolutionary period.
Louise?
I think we've just sped up evolution and it's technology-led, which is exciting.
Frank, are you there?
Yes, I mean, I would match all consensus. I mean, it's got to be an evolution and not revolution. Evolution because the fixed income market is slow in evolving. I would see no impact of IA so far, but I would see impact of digitalization and connectivity improvement.
Cool. Thank you very much indeed. So to wrap up, with fixed income markets are very vast. We have a wide spread of instruments which trade in different ways. We're seeing technical innovation. We're seeing a demand for more transparency, but balance to be delivered in the right way. We're seeing a more demand for data, kind of the key theme coming through from this and making sure we get the data right. But that leaves me to one thing and only is to thank my participants. Thank you so much, guys. It's absolutely brilliant to have such an experienced panel and to be so open with your views. I really appreciate it. And I'm sure everyone else found it very useful. So thank you very much indeed. Cool. So that leaves us to move on to the next panel, which is the FinTech panel, quite nicely in terms of are we seeing a revolution and an evolution in fixed income. We got the fixed income panel in terms of where is the innovation in FinTech and how are we going to see this evolve.